The car market has finally flipped, and almost nobody saw it coming. After years of ridiculous prices, bidding wars, insane dealer markups, and month-long waitlists, the entire industry just hit a wall, and the reversal is happening faster than anyone predicted. For the first time since 2020, we're seeing real, undeniable signs that the bubble has burst. Dealership lots overflowing with inventory, massive price cuts on vehicles that were untouchable just months ago, automakers quietly panicking behind the scenes, and consumers suddenly holding more power than they've had in nearly a decade. It's not hype, it's data. Inventory levels across the country have surged beyond pre-pandemic norms. Incentives are climbing every single week, and insiders are admitting that they all knew the moment the flip happened. They just hoped buyers wouldn't notice. Dealers are now facing a problem they haven't had in years. Too many cars and not enough people to buy them. Truck, SUV, and EV inventory is ballooning to record highs, and some models are sitting on lots for 100, 150, even 200 days without movement. Every day a vehicle sits is another day a dealer loses money. And now, panic is setting in. High interest rates crush demand. Consumers backed out, and dealers are slashing prices just to clear space. Some are even admitting privately that they'd rather take a loss today than carry a unit into December or January. The days of take it or leave it are gone. Now it's please just take it. And that's because the price cuts hitting the market right now are unlike anything we've seen since before 2020. Trucks that stickered at $70,000 just a few months ago are suddenly going for $55,000, $52,000, sometimes under $50,000, with the right incentives stacked. Automakers are quietly running stealth discounts, money on the hood that they're not advertising, but dealers are using to close deals. Used cars are dropping even faster, falling week after week as dealers try to adjust to a market that's changing faster than they can react. The correction that was supposed to take years is happening in months, and it's catching everyone off guard. Automakers are now in full crisis mode. Ford, GM, and Stellantis are all throttling back production, laying off workers, and shutting down factories for weeks at a time just to stop the bleeding. EV overproduction has created a mountain of unsold electric cars across the industry, forcing companies to rethink everything. The big shift emerging now is a return to hybrids, a dramatic slowdown in EV investment, and aggressive discounting to move the metal already built. This isn't a small adjustment. It's a full strategic U-turn from the plans automakers were bragging about just 2 years ago. Meanwhile, buyers finally have the upper hand. Negotiation is back in a big way, and dealers are suddenly throwing out numbers that would have been unthinkable in 2021 or 2022. Cash buyers especially are getting offers that make even seasoned car shoppers do a double take. But there is a catch. Trade-in values are falling like a rock. Cars that were worth $26,000 last year might only fetch $19,000 today. It's a brutal moment for sellers, but an unbelievable opportunity for smart buyers who know how to leverage dealer desperation. And while new car prices are dropping, the used car collapse is happening even faster. CarMax, AutoNation, and other big used car retailers are drowning in overpriced inventory they bought months ago at the top of the market. Now they're stuck with cars they can't move unless they slash thousands off the sticker. Rising repo rates are adding fuel to the fire. More and more vehicles are hitting auctions every week, flooding the used market and pushing prices even lower. Many experts now believe 2024 to 2025 will go down as one of the best buyer markets of the decade. All of this chaos ties back to one major mistake. Automakers assumed buyers would continue paying anything, even with interest rates skyrocketing. But consumers hit the brakes hard. Nobody wants a 12% or 17% APR on a $60,000 truck. And banks tightening lending standards only made things worse. Dealers who swore 0% APR is never coming back are suddenly offering it again because they simply have no choice. And the segment taking the biggest beating? Full-size trucks. The F-150, Silverado, Ram 1500, Tundra, and Sierra all are drowning in oversupply. Automakers built way too many. Fleets canceled massive orders, and now thousands of trucks are sitting with no buyers in sight. Trucks, once the profit engine of the industry, are now the biggest discount category on the market. EVs are facing their own crisis. Tesla's relentless price cuts forced every automaker into a corner, triggering a brutal industry-wide price war. EVs are stacking up on lots for months, and customers are defecting to hybrids at a rate nobody predicted. And just when the US automakers thought things couldn't get worse, Chinese brands are preparing the next shock: hyper-low-cost EVs and hybrids that could undercut everyone. But the hidden bombshell that's about to shake the whole market is repossessions. Defaults are climbing, lenders are getting nervous, and more vehicles are pouring into auctions every single week. Banks are tightening approvals, creating a feedback loop that makes it even harder for dealers to sell. It's the silent crash nobody wants to talk about, but it's already reshaping the market. And now the big question: what happens next? Analysts believe prices will continue sliding into 2025 as inventory remains high, interest rates stay elevated, and repos add even more pressure. Some segments, especially trucks and EVs, could see double-digit percentage drops. The market bottom isn't here yet, but it's coming, and buyers who prepare properly could walk away with the best deals of the decade. Sellers, on the other hand, need to be very careful or risk losing thousands more as the slide continues. This market shift is creating a once-in-a-generation opportunity, but it's also revealing just how fragile the auto industry became during the years of easy money, low rates, and sky-high demand. Dealers who were bragging about record profits just a year ago are now scrambling to survive as margins evaporate and carrying costs explode. Automakers who confidently ramped up production based on pandemic-era demand curves are realizing that the market they planned for no longer exists, and buyers who were once forced to accept outrageous markups and long waitlists are now watching prices fall every single month, finally regaining control after years of being squeezed. The psychology of the market has flipped too. For years, consumers felt desperate, like if they didn't grab a car today, it would be more expensive tomorrow. Dealers fed that urgency with lines like, "Inventory is tight," "This is the last one," or "We have 10 people coming to see it." But now, it's the opposite. Buyers feel confident waiting. They know tomorrow's price might be lower. They know incentives will grow. They know lenders might ease up if the industry gets desperate enough. And the moment buyers gain patience, the entire pricing structure collapses. Dealers can't bluff anymore. Automakers can't pretend demand is strong. The leverage has shifted, and every part of the industry is feeling it. This is also exposing how unrealistic the push toward premium pricing became. Over the last 5 years, the average new vehicle price jumped from the low $30,000 to more than $48,000. Trucks routinely hit $60,000, $70,000, even $80,000 with packages and add-ons. Automakers convinced themselves that customers were fine with luxury-level pricing. But that was only true because interest rates were at historic lows. Now that financing is brutal and incomes haven't kept up, consumers are rejecting these inflated prices, and dealers are being forced to lower them to reality. This is why we're seeing deep cuts on high-trim models: Platinum, Denali, High Country, Limited, because these are the vehicles that were most overpriced during the boom. Another major force accelerating the flip is the collapse of fleet demand. Rental companies, government agencies, and corporate fleets canceled or slashed orders when interest rates spiked. These orders were the backbone of truck and SUV production. Without them, automakers are drowning in extra units. The trucks that were supposed to go to fleets are now sitting on lots with no buyers, creating even more competition among dealers and driving prices down faster. Some insiders say this is the worst fleet pullback since the 2008 financial crisis. At the same time, the technology gap between EVs, hybrids, and traditional gas vehicles is creating even more instability. Hybrids are surging because they offer better gas mileage without the charging headaches. EVs, which automakers invested billions into, are stagnating as consumers push back against range anxiety, charging infrastructure issues, and cold weather performance. Dealerships report hybrid demand is outpacing EV demand 2-to-1 in many regions. Automakers are now shifting research budgets, pulling back EV targets, and quietly delaying electric models that were supposed to launch in 2025 and 2026. It's a dramatic reversal that shows just how quickly consumer sentiment can reshape an entire industry. Underneath it all is a growing fear that the used market crash may get even worse. Repo specialists report they're picking up cars from people who bought at peak prices and simply can't keep up with payments anymore. Some owners are upside down by $10,000 or more, trapped in loans with high APRs on cars that lost value far faster than expected. As more of these vehicles hit auctions, wholesale prices fall, and used dealers have no choice but to drop retail prices even further to stay competitive. This downward pressure could continue deep into 2025, especially if economic stress worsens or job markets tighten. Even the lending landscape is shifting dramatically. Banks that were approving loans with stretched terms, 72, 84, even 96 months, are now tightening standards, rejecting more applicants, and demanding stronger credit. Subprime approvals have dropped heavily. This reduces the number of qualified buyers in the market, which increases dealer desperation and accelerates price declines. Some banks are also increasing repossession efforts earlier in the delinquency cycle to reduce their risk, adding even more volume to auctions already overflowing with vehicles. For the first time in years, automakers are openly acknowledging that affordability, not production capacity, not supply chains, not chip shortages, is the #1 problem they face. Consumers are rejecting overpriced vehicles, and no marketing campaign can fix that. The entire industry is being forced to reset its expectations and rebuild strategies in real time. They're cutting shifts, slashing production targets, and offering incentives that were unthinkable just a year ago. Some industry insiders believe that this reset could permanently change how vehicles are priced and sold going forward, ending the era of unchecked markups and inflated MSRPs. And as this shift continues, something deeper is happening. Buyers are becoming smarter. Years of being burned by high prices, shady tactics, and predatory markups have pushed consumers to research harder, negotiate tougher, and walk away more often. Social media has made dealer scams go viral, empowering buyers to call out bad behavior instantly. Forums and videos are teaching people how to identify hidden incentives, analyze price trends, and get deals that used to require insider knowledge. This new consumer awareness is making it even harder for dealers to play the old games that worked during the boom years. All of this is creating a chain reaction that's pushing the market toward one undeniable reality. The correction is far from over. Dealers are now quietly admitting that even with heavy discounts, foot traffic remains weaker than expected. Buyers aren't rushing back in. They're waiting, watching, and anticipating even better deals. That hesitation alone is enough to force further price cuts, especially as the holiday season approaches and automakers scramble to hit quarterly targets. Some dealers are even reporting that customers are coming in, test driving vehicles, getting quote sheets, and then saying, "I'll come back in a month when the price drops again." A few years ago, dealers would have laughed someone out of the building for saying that. Today, they're anxiously wondering if the customer is right. The ripple effects are even hitting warranty companies, insurance providers, and aftermarket businesses. Extended warranty claims are rising because owners are stretching vehicles longer, trying to avoid upgrading in this chaotic market. Insurance companies are recalculating premiums because the value of certain cars is falling so quickly that repair-to-value ratios are shifting. Even service departments, which normally stay strong during downturns, are seeing a strange trend. People delaying repairs that aren't urgent, hoping to avoid putting money into cars that might soon lose thousands in value. The entire ecosystem around vehicles is feeling the pressure of a collapsing market. On the manufacturing side, suppliers are experiencing their own crisis as automakers cut orders. Parts suppliers, especially those dependent on EV components, are reporting sudden cancellations and shrinking contracts. Some factories that expanded aggressively during the 2021 to 2022 boom are now operating at half capacity. The slowdown is so sharp that some suppliers are preparing for consolidation, bankruptcy filings, or mergers just to stay afloat. It's a reminder that when the auto industry sneezes, everyone in the supply chain catches a cold. Meanwhile, Automakers are trying to pivot their marketing strategies to keep buyers engaged. Expect to see more limited-time offers, holiday blowouts, and record-breaking savings, because manufacturers know they must reset consumer expectations without tanking their brand image. They can't openly say, "We overpriced everything for years," but their incentives and discounts are saying it for them. Several brands are even preparing incentive programs targeted at specific demographics, like first-time buyers, military members, or teachers, to widen the pool of potential customers. It's a sign that they're trying to manufacture demand in a market that doesn't naturally have it anymore. But the biggest wildcard right now is the global landscape. International automakers, especially from China, are gearing up for an aggressive push into North America, bringing affordable hybrids and EVs that could undercut US pricing by thousands. If regulatory hurdles loosen or partnerships emerge, the American market could see a shockwave similar to what happened decades ago when Japanese brands arrived with reliable, low-cost cars that reshaped the entire industry. US automakers know this, and some executives are warning privately that if pricing pressure keeps building, the next stage of the flip could be a full-scale price war that pushes profits even lower. At the same time, buyer behavior is shifting toward practicality over prestige. People who once aimed for top trims are now settling for mid-level or base models to save money. Truck buyers who would never consider a hybrid are now test-driving them for the fuel savings. Shoppers who ignored sedans for years are suddenly rediscovering them because they offer the best price-to-value ratio on the market. This psychological shift toward frugality is reinforced every time someone sees another headline about falling prices, repossessions, or dealership overstock. One of the most overlooked components of this flip is the social status factor. For years, driving a brand new truck or SUV felt like a badge of success. But now, many consumers are quietly embarrassed to be paying top dollar when everyone else is bragging about the deals they're getting. The conversation has flipped from, "Look what I bought," to, "Look how much I saved." This cultural shift adds even more pressure on dealers to keep lowering prices, because nobody wants to be the person who paid thousands more than they had to. And beneath all of this, there's a growing fear that if interest rates stay high into 2025, the market could enter an even deeper downturn. Industry analysts warn that if unemployment rises even slightly, repossessions could spike dramatically, flooding the market with even more used vehicles and pushing prices lower. Auto lenders are already adjusting for this risk, setting aside more capital for potential loan losses and tightening approval rates even for well-qualified buyers. This tightening makes it harder for dealers to close deals, which then forces even more aggressive discounts, creating a downward spiral the industry can't easily escape. This brings us to the real heart of the flip: affordability. The market isn't crashing because people don't want cars. It's crashing because people can't justify the cost anymore. This is the first time in years that the financial side of car ownership has outweighed the emotional side. And once affordability becomes the driving factor, the entire market recalibrates. That's why we're seeing incentives rise across the board, why automakers are rethinking trim strategies, and why dealers are abandoning the high markup tactics that made them billions just a short time ago. As we move deeper into this market shift, something even more remarkable is happening. Consumers are getting smarter not just about pricing, but about timing. Unlike the frenzy of the past few years where people bought whatever was available, buyers today are studying trends, tracking incentives, and watching inventory the same way investors track stocks. They're learning that certain models drop faster than others, certain regions offer bigger discounts, and certain dealers are more desperate than the rest. This new data-driven buyer behavior is accelerating the flip because people now understand the power of waiting. They've realized that patience is no longer a risk, it's a strategy. This dynamic is hitting premium brands especially hard. Luxury SUVs and high-end trucks are sitting longer than ever, with many buyers realizing they can get nearly the same features and sometimes better reliability from mainstream brands for tens of thousands less. This erodes the premium market in a way luxury automakers weren't prepared for. Mercedes, BMW, Cadillac, and Lexus are offering discounts quietly behind the scenes to avoid public embarrassment, but dealers know they must cut deeper if they want to move aging stock before the year closes. And the really surprising part? Even ultra-high-end brands like Porsche and Land Rover are facing slowing demand as buyers look at $1,000 plus monthly payments and simply walk away. Meanwhile, the rental car industry, which once absorbed enormous amounts of production, is also tightening its belt. Fleet companies are no longer buying aggressively. Instead, they're offloading older vehicles into the used market faster than expected. These ex-fleet cars, trucks, crossovers, and compact sedans are entering auctions in huge waves, contributing to an oversupply that weighs heavily on used prices. When fleet liquidation aligns with rising repossessions, the used market doesn't just soften, it buckles. And that's exactly what we're watching play out. Another major driver of this flip is the rapid depreciation hitting vehicles purchased at peak pandemic pricing. People who bought cars in 2021 or 2022 are now discovering their vehicles are worth far less than expected.